Assalamualaikum warahmatullahi wabarakatuh. We are from Group 6. We would like to present about our report title, Financial Report MW Berhad and Aesthetic International Group Berhad. Our group have 5 members. First, Siti Hawa binti Muhammad Yahaya, H22A0567. Second, Nurul Atira Natasha binti Zainuddin, H22A1268. Third, Muhammad Aizuddin bin Muhammad Zakaria, H22A0729. Next, Aiman Hakim bin A. Razak, H22A0369. And last, Nur Hadri Milzam bin Ahmad Khairuddin, H22A0328.
The following are the companies we choose. Firstly, MW Berhad, and the second, Aesthetic International Group Berhad. For the introduction part, MW Berhad and Aesthetic International Group were the companies chosen to be analysed in the present study. Each has benefit and drawback of its own. As a result, it is able to access the company analysis trend and make comparison between the two industries. The two companies are involved in the healthcare sector. The histories of the two businesses make this clear. The study will receive us into great detail on the criteria to help us select this business, to serve as a precise guide for determining the maximum profit that be achieved in the suitable period of time. Okay, let's move to the background of the companies. Firstly, MW Berhad. MW, short for the American Way, is a direct selling company that was founded by J. Van Andel and Richard DeVos in 1959. MW initially focused on household cleaning products, with their first product being a biodegradable and concentrated liquid organic cleaner called Frix. In 1949, Van Andel and Richard DeVos became distributor for Nutrilite. And secondly, Aesthetic International Group Berhad. Aesthetic International Group Berhad is a leading beauty and health company in Asia and Hong Kong, with over 38 years of experience in the industry. Aesthetic International Group Berhad owns and operates a leading chain of more than 70 after spring skincare salon and retail counters strategically located in shopping malls and key retail locations in Malaysia, Singapore, Hong Kong, Thailand and Indonesia. Okay, let's move to the ratio analysis. 3.1 Trend analysis for the company A, MW Berhad 2018. Based on the table above and this liquidity ratio, MW Berhad appears to have a comfortable liquidity position in 2018 with a current ratio above 1, a quick ratio above 1 and a positive net working capital. This ratio suggests the company has the ability to meet its short-term obligation. Next, for the activity ratio, total asset turnover is calculated by dividing sales by total assets. For MW Berhad in 2018, the total asset turnover was 2.41, indicating that the company generates sales of 2.1 for every one of total assets. This ratio measures the efficiency of asset utilization. And next, for the account receivable revenue, MW Berhad account receivable turnover in 2018 was 21.52, indicating that on average the company collects its account receivable about 21.52 times throughout for the year. And for the average collection period, MW Berhad average collection period in 2018 was 60.69 days, showing that on average it takes about 60.96 days to collect payment for the customer. And the second last is the inventory turnover. MW Berhad inventory turnover in 2018 was 77.38, indicating that the company sold and replaced its inventory 7.38 times throughout the year. And the lastly is fixed asset turnover. MW Berhad fixed asset turnover in 2018 was 12.63, indicating that the company generated sales of 12.63 for every one of fixed assets. Based on this activity ratio, MW Berhad in 2018 appears to using its asset efficiently, managing its account receivable effectively, collecting payment relatively quickly, and turning over inventory and fixed asset at the favorable rates.
Next, let's look at the leverage and debt ratios. Awi Berhad had a debt ratio of 0.46, which means the debt ratio for Awi Berhad in 2018 was 0.46. This indicates that the company's total liabilities represented 46% of its total assets. A lower debt ratio suggests that the company has a lower reliance on debt to finance its assets, which can be seen as a positive indicator of financial stability and lower financial risk. The debt to equity ratio was 1.12. This indicates that the company had a higher amount of debt in relation of its equity. A higher debt to equity ratio can suggest that the company is financing its growth through debt rather than equity, which may indicate higher financial risk and a greater reliance on borrowing to finance its operations. These ratios provide insights into the company's, which is Awi Berhad, as it exhibited a moderate level of financial risk in 2018, as indicated by its debt ratio of 0.46 and debt to equity ratio of 1.12. This ratio suggests that the company had a moderate reliance on debt to finance its assets and operations, while the debt ratios indicate a reasonable level of financial risk. It is important to consider the company's overall capital structure and its ability to meet its debt obligations. Additionally, a comprehensive analysis of Awi Berhad's financial risk should include an assessment of its cash flow, profitability, and industry comparisons. Overall analysis. In this analysis, both Awi Berhad and Aesthetic International Group Berhad showcase distinct capabilities in generating their incomes. However, Awi Berhad appears more stable and effective in terms of its financial performance compared to the other company, which is Aesthetic International Group Berhad. One notable aspect is their inventory turnover, where Aesthetic International Group Berhad significantly outperformed Awi Berhad in 2019, indicating better production and sales efficiency. Despite this, Awi Berhad demonstrated a higher gross profit margin and maintained their consistency in gross profits, and making it an attractive option for investors due to its financial stability. The increased debt ratio for Awi Berhad, while rising from 2018 to 2019, has not deterred investor interest, possibly due to other favorable factors influencing their decision-making process. Overall, as an investor, choosing Awi Berhad seems more appealing due to its consistent gross profit and perceived financial reliability despite the increased debt ratio.
Liquidity ratio. Liquidity ratio in 2019, MW Berhad had a current ratio of 1.61, indicating in 2019, MW Berhad had a current ratio of 1.61. This ratio indicates the company's ability to pay its short-term obligation using its current asset. A current ratio of 1.61 suggests that the company had a $1.61 in current asset available to pay off each $1 of its current liability. This indicates that the company had relative strong liquidity position in 2019, as it had sufficient current asset to meet a short-term obligation. However, it is important to note that high current ratio may also indicate that the company is not efficiently utilizing its current asset to generate profit. Therefore, it is important to consider other financial ratio and factor when evaluating a company financial performance. The quick ratio was 1.07, suggesting in 2019, and Weberhard had a quick ratio of 1.07. The quick ratio measures the company's ability to meet short-term obligation without relying on inventory. A quick ratio of 1.07 suggests that the company had $1.07 in liquid assets, such as cash and account receivable, available to cover its $1 of its current liability. This indicates that the company had a reasonable ability to meet its short-term obligation without relying on the sale of inventory. Overall, the quick ratio of 1.07 indicates that Weberhard had a satisfactory liquidity position in 2019, as it had a sufficient level of liquid asset to cover short-term liability. This ratio reflects the company's ability to, based on the liquidity ratio of Weberhard in 2019. The company had a relatively strong liquidity position. The current ratio of 1.67 indicates that the company had sufficient current asset to pay off its current liability. The quick ratio of 1.07 suggests that the company had a reasonable ability to meet its short-term obligation without relying on inventory. However, compared to previous year, the current and quick ratio decreased slightly, indicating a slight weakening of the company liquidity position. It is important to note that liquidity ratio provide only the snapshot of a company financial position at a specific point in time, and should be evaluated in conjunction with other financial ratio and factor to gain a comprehensive understanding of a company financial performance. Okay, moving to activity ratio. We see that Weberhard had a total asset turnover ratio of 2.18, which means in 2019, Weberhard had a total asset turnover ratio of 0.65. This indicates that the company generates $0.65 in revenue for each $1 of its total asset. Compared to previous year, the total asset turnover ratio decreased slightly, which may suggest that the company was less efficient in utilizing its asset to generate revenue in 2019. However, it is important to note that the ideal total asset turnover ratio varies by industry and company size, and it is important to compare the ratio with industry benchmark and historical data to gain a better understanding of the company performance. Overall, a low total asset turnover ratio may suggest that Weberhard could improve its efficiency in utilizing its asset to generate revenue. The account receivable turnover ratio was 21.59, indicating in 2019. And Weber had an account receivable turnover ratio of 21.59. This indicates that the company collected its account receivable approximately 21.59 times during the year. A high account receivable turnover ratio suggests that the company was efficient in collecting payment from its customer. A high account receivable turnover ratio is generally favorable, as it indicates that the company is effectively managing its credit and collection policies, resulting in a shorter time between making a sale and receiving payment. This can positively impact the company cash flow and overall financial health. Overall, the high account receivable turnover ratio for Weber in 2019 suggests that the company had an efficient credit and collection process, which is a positive indicator of its financial management. The inventory turnover ratio was 0.83 in 2019. And Weber had an inventory turnover ratio of 5.97. This indicates that the company sold and replaced its inventory approximately 5.97 times during the year. A higher inventory turnover ratio suggests that the company was efficient in managing its inventory and was able to sell its product quickly. A high inventory turnover ratio is generally favorable. It is indicate that the company is effectively managing its inventory level, resulting in the shorter time between purchasing inventory and selling it. This can positively impact the company cash flow and overall financial health. Overall, the inventory turnover ratio for Weber in 2019 suggests that the company had an efficient inventory management process, which is a positive indicator of its financial management. Okay, leverage debt ratio. Weber had a debt ratio of 0.50, which means in 2019, Weber had a debt ratio of 50%. The debt ratio, also known as the debt to asset ratio, measures the proportion of a company asset that are financed by debt. A debt ratio of 50% indicates that half of Weber assets were financed by debt. A debt ratio of 50% suggests that Weber rely on moderate level of debt to finance its asset. This ratio provides insight into the company leverage and financial risks. A highest debt ratio indicates higher financial risk and potential vulnerability to economic downturn or rising interest rate. It is important to note that the interpretation of the debt ratio should be considered in conjunction with other financial metrics and industry benchmark to gain a comprehensive understanding of the company's financial health and risk profile. The debt to equity ratio was 1.33, indicating in 2019, Weber had a debt to equity ratio of 1.33. The debt to equity ratio measures the proportion of a company financing that they come from creditor compared to which come from shareholder. A debt to equity ratio of 1.33 indicate that for every dollar of equity, the company had $1.33 of debt. A debt to equity ratio of 1.33 suggests that NW Berhad rely more on debt financing than equity financing to fund its asset and operation. This ratio provides insight into the company capital structure and financial leverage. A highest debt to equity ratio indicates higher financial risk and potential vulnerability to economic downturn or rising interest rate. It is important to consider the debt to equity ratio in the context of industry norm and the company historical ratio to assess its financial risk and leverage position accurately. This ratio provide insight into the company, the financial risk and capital structure of a company are critical factors that can impact its financial health and sustainability. Profitability ratio. Profitability ratio, and we had a return on equity on 0.23, which means in 2019, and we had achieved a return on equity of 23%. Return on equity measure a company profitability by evaluating how effectively it generates profit from shareholder equity. A 23% return on equity indicate that every dollar of equity invested by shareholder and Berhad generate a profit of 23 cents. This suggests that the company efficiently utilize shareholder fund to generate earning. A highest return on equity generally considered favorable as its significant efficient utilization of equity capital to generate profit. And we had return on equity of 23% indicate strong profitability and efficient management of shareholder investment. It's important to compare this return on equity with industry average and the company historical performance to gain a comprehensive understanding of its profitability and to assess its performance relative to its peer. Move the group profit margin was 0.25, indicating in 2019 Weber had achieved a gross profit margin of 25%. The gross profit margin measures the percentage of revenue that exceed the cost of goods sold, reflecting the company ability to control production costs and set pricing effectively. A gross profit margin of 35% indicate that for every dollar of sale revenue, and we had retained 25 cents at gross profit after accounting for the cost of goods sold. This suggests that the company effectively managed its production costs and pricing strategies to generate a strong gross profit margin. Highest gross profit margin is generally favorable as it indicates efficient cost management and pricing strategies. NW Berhad gross profit margin of 25% reflects strong control over production, cost and pricing, contribute to its overall profitability. It's important to compare this gross profit margin with industry benchmark and the company historical performance to assess its competitiveness and operational efficiency accurately. Next, the net profit margin was 0.05, suggesting in 2019, NW Berhad achieved a net profit margin of 5%. The net profit margin measures the percentage of revenue that remain as net profit after accounting for all expense including tax and interest. A net profit margin of 5% indicate that for every dollar of sale revenue, NW Berhad retain 5% as net profit after accounting for all expense. This suggests that the company effectively managed its expense including tax and interest to generate a reasonable level of net profit. A highest net profit margin is generally favorable as it indicates efficient cost management and effective revenue generation. While NW Berhad net profit margin of 5% is relatively low, it still reflects the company's ability to generate a reasonable level of net profit after accounting for all expense. It's important to compare this net profit margin with industry benchmark and the company's historical performance to assess its competitiveness and profitability accurately.
I will be presenting the trend analysis of Aesthetic International Group Berhad 2018 and 2019. Let's start with the liquidity ratio. In 2018, Aesthetic International Group Berhad had a current ratio of 2.44, which is higher than the industry average. This indicates that the company has a strong ability to pay its short-term obligation on time. The quick ratio, which measures the company ability to meet its current liability with its most liquid assets, was also high at 1.92. This suggests that the company has a good level of cash and non-cash asset to cover its current liability. Moving on to the activity ratio, we see that Aesthetic International Group Berhad had a total assets turnover ratio of 0.65, which means that the company generates 65 cents of sales for every dollar of assets it had. The account receivable turnover ratio was 6.58, indicating that the company was effective in collecting payments from its customer. The inventory turnover ratio was 5.97, which means that the company was able to sell its inventory almost 6 times during the year. The fixed asset turnover ratio was 1.37, indicating that the company generated 1.37 of sales for every dollar of fixed asset it had. Finally, the average collection period was 46.32 days, which means that it took the company an average of 46 days to collect payment from its customer. Average debt ratio, Aesthetic International Group Berhad had a debt ratio of 0.28, which means that 28% of its assets were financed by debt. The debt to equity ratio was at 1.88, indicating that the company had more debt than equity in its capital structure. Finally, the time interest earned ratio was negative 0.2, which means that the company did not have enough earning to cover its interest expenses. Profitability ratio at a return on equity of 8%, a return on asset of 5%, a gross profit margin of 56%, and operating profit margin of 8%, and net profit margin of 8%. This ratio provides insight into the company profitability and efficiency in generating profits from its operation. A higher ROE and ROA indicates that the company is generating more profits relative to its equity and asset, respectively. Equity ratio at a total asset turnover ratio of 0.30. This indicates that the company generates 0.30 in sales for every dollar of total asset. The account receivable turnover ratio was 0.73. This indicates that the company collected its account receivable approximately 0.79 times during the year. The inventory turnover ratio was 5.16. A higher inventory turnover ratio generally suggests that the company was able to sell its inventory quickly. This ratio provides insight into the company operational efficiency and performance in utilizing its resources to drive sales and manage its working capital. Next, let's look at the leverage debt ratio. The Static International Group Berhad at a debt ratio of 0.29. A lower debt ratio suggests that the company relied less of debt financing to support its asset. The debt to equity ratio was 0.55. This indicates that the company's total debt was 55% of its total equity. This ratio is important for assessing the company capital structure and financial risk, which is a key factor in determining the company ability to meet its financial obligation and sustain its operation over the long term. Profitability ratio at a return on equity of 8%, a return on asset of 5%, a gross profit margin of 56%, and operating profit margin of 8%, and net profit margin of 8%. This ratio provides insight into the company profitability and efficiency in generating profits from its operation. A higher ROE and ROA indicates that the company is generating more profits relative to its equity and asset, respectively. The comparative analysis between Company A and Company B in terms of liquidity ratio in 2018 reveals the following current ratio: Company A 1.75, Company B 2.44. Company B has a higher ratio indicating better ability to pay its short-term obligation on time. Quick ratio: Company A 1.22, Company B 1.92. Company B has a higher ratio indicating better ability of cash and non-cash asset without inventory to cover current liability. Net working capital: Company A 139,563,000 to 741,090,000. Company A has a higher positive value or a high ratio depositing the invested equity capable of generating high profits. Activity ratio in 2018: total asset turnover, Company A 2.41, Company B 0.65. Company A has a higher ratio indicating better efficiency in using its asset to generate sales revenue. Account receivable turnover: Company A 21.52, Company B 6.58. Company A has a higher ratio indicating better effectiveness of accounts receivable of generate sales. Average collection period: Company A 16 days, Company B 46 days. Company A has a lower ratio indicating a shortened time taken to collect its account receivable. Leverage debt ratio in 2018 reveals the following: debt ratio: Company A 50%, Company B 29%. Company A has a higher ratio reflecting the higher amount of debt. Debt to equity ratio: Company A 133%, Company B 55%. Company A has a higher ratio indicating a higher level of financial leverage. Time interest earn ratio, Company A 9.82, Company B 7.86. Company A has a higher ratio indicating the firm ability to meet loan requirement and lower the risk of default. Profitability ratio in 2018, return on equity ROE, Company A 3%, Company B 2%. Company A has a higher ratio indicating a higher return to shareholders. Return on asset, Company A 14%, Company B 2%. Company A has a higher ratio indicating a higher return on the firm investment. Gross profit margin, Company A 25%, Company B 56%. Company B has a higher ratio indicating a larger contribution margin. Operating profit margin, Company A 7%, Company B 8%. Company B has a better ratio indicating trends over time, and cooperations with industry peers can provide valuable insight into company competitiveness and sustainability. Last, net profit margin, Company A 5%, Company B 8%. Company B has a higher ratio indicating the firm net profit as a percentage of revenue.
For a cooperative between NW Berhad, Company A, and STT International Group Berhad is Company B in 2019. For liquidity ratio, NW Berhad Company and STT International Group Berhad. For 2019, current ratio for NW Berhad Company is 1.61. For STT International Group Berhad is 2.33. For a cooperative, Company B has a highest ratio which reflect the company ability to obtain cash to pay debt in a short period of time. For a quick ratio, NW Berhad Company is 1.07. For STT International Group Berhad is 1.73. For cooperative, Company B has a highest ratio that reflect its ability to meet short-term obligation without relying on inventory. For net working capital, for NW Berhad Company is 13113900. For STT International Group Berhad is 72038000. For a cooperative, Company A has a higher positive value as an absolute measure of liquidity. For activity ratio, NW Berhad and STT International Group Berhad. For a total asset turnover in 2019, NW Berhad is 2.18. For STT International Group Berhad, 0.30. For a cooperative, Company B has a highest ratio reflecting the effectiveness of total asset to generate sale. For account receivable turnover, NW Berhad is 21.59. For STT International Group Berhad is 0.79. For cooperative, Company B has a highest ratio reflecting the effectiveness of total asset to generate sale. For average collection period, for NW Berhad is 16 day, 0.9 day, and for STT International Group is 55.46 day. For the cooperative, the greater ratio for Company B indicate how well its overall asset work to drive sale. For inventory turnover, NW Berhad is 0.83. For Aesthetic International Group Berhad is 5.16. For cooperative, Company B has a great ratio how well its fixed asset produce revenue. For the fixed asset turnover, NW Berhad is 9.92. For Aesthetic International Group Berhad is 13.82. The cooperative Company B has a highest fixed asset turnover, which can provide more meaningful insight into the company performance and efficiency in utilizing. Okay, for the leverage debt ratio. For debt ratio, NW Berhad in 2019 is 50%. For Aesthetic International Group Berhad is 29%. Interpretation, Company A has a great ratio which can amplify return on equity but also increase financial risk. For debt to equity ratio, NW Berhad is 133%. For Aesthetic International Group Berhad is 55%. For interpretation, Company A highest ratio reflecting the highest amount of debt. For time interest earned ratio, for NW Berhad Company is 9.82. For Aesthetic International Group Berhad is 7.86. For interpretation, Company A has a highest ratio indicating that the firm can meet loan requirement and lower the risk of default. Okay, profitability ratio. For NW Berhad and Aesthetic International Group Berhad in 2019. First, return on equity. For NW Berhad in 2019 is 23%. For Aesthetic International Group Berhad is 8%. Interpretation, Company A has a good ratio better than Company B, which is the company past performance and provide additional insight and qualitative factors should be considered for a comprehensive analysis for company financial health. Second, return on asset. For NW Berhad is 12%. For Aesthetic International Group Berhad is 5%. For interpretation, Company A has a highest ratio indicate a highest return on the firm investment. For NW Berhad Company is for a gross profit margin is 25%. For Aesthetic International Group Berhad is 56%. For interpretation, according to the data, Company A has a bigger contribution margin. Number 4, operating profit margin. For NW Berhad is 7%. For Aesthetic International Group Berhad is 8%. For interpretation, Company B has a better ratio indicating trend over time and cooperation with industry peer can provide valuable insight into a company competitiveness and sustainability. For a net profit margin, NW Berhad is 5%. For Aesthetic International Group Berhad is 8%. Interpretation, Company B has a highest ratio, which is that the company is managing its costs more effectively or experiencing growth in revenue.
Finally, we come to the profitability ratios. NW Berhad had a return on equity of 0.03, which means the return on equity for NW Berhad in 2018 was 0.03. This indicates that the company generated a profit of RM0.03 for every 1 ringgit of shareholder equity. A higher return on equity is generally seen as a positive indicator of a company's profitability and efficiency in utilizing shareholder investments. However, it is important to note that the return on equity should be analyzed in conjunction with other financial metrics to gain a comprehensive understanding of the company's financial performance. The gross profit margin was 0.25, indicating the gross profit margin for Abu Berhad in 2018 was 0.25. This indicates that the company earned Rn 0.25 in gross profit for every RM1 in sales revenue. A higher gross profit margin is generally seen as a positive indicator of a company's ability to generate profits from its sales. However, it is important to consider the company's industry and competitors when analyzing the gross profit margin, as well as other financial metrics such as operating expenses and net profit margin. The net profit margin was 0.06, suggesting the net profit margin for Abu Berhad in 2018 was 0.06, which indicates that the company earned RM0.06 in net profit for every RM1 in sales revenue. The net profit margin is a key indicator of a company's profitability as it takes into account all expenses, including operating expenses, interest, and taxes. A higher net profit margin is generally seen as a positive indicator of a company's ability to generate profits from its operations. However, it is important to consider the company's industry and competitors when analyzing the net profit margin, as well as other financial metrics such as gross profit margin and return on equity. These ratios reflect the company's Abu Berhad as exhibited a moderate level of profitability performance in 2018 and 2019, as indicated by its gross profit margin, operating profit margin, and net profit margin.
In summary, the financial analysis revealed the strengths and weaknesses for both Abu Berhad and Aesthetic International Group Berhad. Aesthetic International Group Berhad demonstrates superior net working income and inventory turnover, reflecting efficient stock management, though it is not for its lower stability. Conversely, Abu Berhad excels in stability and net sale, suggesting a more reliable performance. Aesthetic International Group Berhad appears to have a more favorable financial position and operational efficiency, but a comprehensive assessment should consider additional metrics, market trends, and industry factors. Ongoing monitoring is essential for accurate and up-to-date evaluation of financial performance. That's all for us. Thank you.